reading and studying Art's work, really as long as I've been following Brian Shannon's work. I mean, it is really what it is. Art, are you there?
I am here, JC. Thanks very much.
Beautiful. Definitely welcome to Chart Summit. So far, this has been absolutely spectacular. Not to mention the attendance level. This room's about to shut down because we're at max capacity. So obviously, there's a lot of interest, which is tremendous. But even if there wasn't, just selfishly, just me as a market geek, I'm having a grand old time here. So. I hope the rest of you are as well. Thanks for all the kind words you guys are sharing on Twitter. Just make sure, if you guys are tweeting stuff out, if you like what Brian had to say or Joe Fahmy or, what Art's about to say, feel free to tweet it out. Use the hashtag Chart Summit. And if you guys are curious to see who's coming up the rest of the afternoon, just go to chartsummit.com and you can see the entire schedule there. I wanted to bring in Art. Greg Schnell earlier this morning, also an analyst at StockCharts.com, tremendous platform. Art, I'm not sure if you got an opportunity to see it, but he did the whole scooter presentation. It was tremendous. I've seen him do it before. I think it's a great value add to really help investors find stocks that are showing both momentum and relative strength, which are two of the most important things that we want to look at. So I think Art is the unique perspective that he brings in is more from a quantitative perspective and looking at breadth and everything like that. And I'm not gonna go too far. I think your work speaks for itself. Have at it. Do your thing, man.
All right, JC. Hey, thanks very much for putting together this awesome event. You really got a really good lineup of speakers, and I'm very proud to be part of it.
I think we're all happy that you're included for sure.
All right, thank you, thank you. So as you can see, here's the title we're going to talk about. I am a senior technical analyst at stockcharts.com. And basically what we're dealing with is a game of odds. There are no guarantees when you're playing, trading, investing in the stock market. And what we need to do is look for ways to increase our odds. And I'll start off with a little blackjack analogy because I've always liked blackjack. When you sit down at the table, there are things that you know and there are things that you don't know. All right, there's not much we can do about the things we don't know. However, we can work with the things that we do know to develop a strategy. So the unknowns in blackjack would be the dealer's down card or the next card coming off the deck. We do know our cards, we know the dealer's up card, and we know the composition of the deck. Now, of course, we don't know everything. We don't know the next card, but we do know that 38% of the cards in the deck are going to be 9 or 10. And that helps us formulate a strategy to make our bets. So we know when to double down, to hit, to stand, or to even split. It's valuable information. It's basically called basic strategy in blackjack. And so what I'm going to try and do is give you a basic strategy in the stock market, something that you can use to identify a bull market and a bear market, and then how we can find the strong parts of the market. So let's see if we can go get that elusive chicken dinner. So as I see it, there are two ways to increase your odds in the stock market. First and foremost, we need some market timing. All right, we need to know the broad trend for the broader market. We want to be long stocks when the big trend is up. We want to be out when the big trend is down. Second, we also want to look at the breadth indicators because that helps us identify a true bull or a bear market. All right, it depends on participation. And if too many stocks are going down, then that tells you participation is not there and you're in a bear market. If the majority are going up, you're in a bull market. And that tells you to run with the bulls. So once we've done that and we've identified our market environment, then we turn to the sectors. All right, and we're going to use the breadth indicators and we're going to rank those sectors, and that's where we're going to find the strongest stocks. And this is a theme that you've heard over and over again at this chart summit is relative strength, new highs, winners, winners buy winners. All right, if you want to own a winning stock, buy one that's winning. So all the charts and indicators come from, of course, stockcharts.com. I do that. It's a great platform, as JC had mentioned. You can also sign up for a free 10-day trial. So start with broad market timing, because as Brian Shannon just mentioned, the majority of stocks decline in a bear market. So why would you want to try and go pick the 20% that are going to go up? It's a losing battle. And so that's why we need to identify the big uptrends and the big downtrends. And so I'm going to do some back testing and show you that we can do something that has a positive expectancy. In other words, it has made money over time. Now, the biggest or the baddest or the worst thing that can happen to you is to get caught in a bear market. So this is a chart going back to 1990. And you can see here in the 90s, man, everybody made money. We had a roaring bull market, especially from 95 up until 99. And then things got different from 2000 on. We had a big bear market there, down 47%. Then we had a nice bull run, and then another bear market, down 53%. And now we're in the midst of a very big run. All right, below I've got the 12-month rate of change. But you can see here, you know, you would have spent 2 years underwater. That would have hurt. And down here. So when I do these back tests, I'm going to focus on this period from 2001 until 2016, because that was a tough time. I could include the 90s, but that'll give it a positive bias. So I'm just going to include this part right here in this back testing. We don't want to make it too easy. So we're going to look at buy and hold returns. What if you were a buy and hold investor during those periods? Well, you can see here that the drawdowns are clearly unacceptable. NASDAQ 100, 70% would have been your maximum drawdown. You had better returns from mid caps and small caps, but you can see the drawdowns were over 50% as well. So the key is in a bull market to make money, but in a bear market, you want to preserve your capital. And that's what we got to do. We got to reduce these drawdowns. Now, the most obvious method is a moving average. And sure, you can catch big trends with the moving average, but you're still going to get lots of whipsaws. You can see here, this is a 200-day EMA, probably the most popular EMA that there is out there. But you can see here, I've got the PPO down here. This is the percentage price oscillator. It's basically a percentage version of MACD. And so when I set it at 1/201, it's positive when price is above the 200-day moving average, and it's negative when price is below the 200-day moving average. So you can see from 2001 and 2, it was mostly below, but you had some whipsaws. And from 2003 through 2007, it was mostly above, but again, you had some whipsaws. And further on, you can see you get mostly above, but you still get a lot of whipsaws. And so we got to learn how to reduce those whipsaws. You don't want to be selling on every break of the 200-day. In fact, here you would have wanted to have been buying on a break below the 200-day. So the key is smoothing. A little bit of smoothing goes a long way to reducing your whipsaws. So this is a basic, I'll call it the golden EMA cross. And you've all heard of the golden cross, the 50-day moving average and the 200-day moving average. As a personal preference, I like exponential moving averages. So this is the S&P 500 SPDR with the 50-day and the 200-day. And I've got the PPO below. And there you can see 50, 201. A lot fewer whipsaws. Stayed below in 2001, 2002, crossed above in 2003, stayed above for a few years, then crossed below for over a year, and crossed above. Now, we're not going to eliminate whipsaws totally, but you can see that a little smoothing goes a long way. Now, here we had some whipsaws in 2015 because that was a pretty tough year, or the end of 2015, beginning of 2016. All right, but let's quantify this. All right, so I ran some back tests to see how much smoothing really helps and if it does, in fact, help. So what I've got here is I've got a table, and I've got the 200-day EMA is your long EMA each time. Then I've got the close, the 5-day EMA, smoothing more to the 20-day, and smoothing more to the 50-day. And we're testing SPY over that 16-year period. So you can see exposure is roughly the same, 70–71%. All right, but you can see that the returns increase as the smoothing increases. All right, you can also see that we have lower drawdowns. The drawdown went from 24% to around 18%. So you had a 7% return per year over the last 16 years and an 18% maximum drawdown. That's not too bad for just a basic golden EMA cross. And you had a much higher win percent. Went from 30% win rate when we had the close in the 200-day EMA, which is the first chart, to an 83% win rate. A lot fewer signals, and so that's a lot fewer hassle. So this is kind of the long-term timing that I'm using to time the broader market. And I think that the S&P 500 is the single most important index that you need to focus on. And by extension, we could say that SPY is. So why focus on the S&P 500? Well, the total market capitalization is about 80% of the total U.S. stock market. The total investable U.S. equity market, 80% is the S&P 500. It's the elephant in the room. It's the most widely followed benchmark out there, hands down. EMA crossovers work. Now, I'm not going to go out and say that the 50-day, 200-day EMA crossover is going to work on every stock or every sector ETF or every industry group ETF or every commodity. No, it's going to be different. But for some reason, this 50, 200-day cross works quite well for the S&P 500. We just showed it. All right, and it seems simple, but sometimes simple is good. We can also use this crossover for the S&P 500 to time other index ETFs. Now, what exactly do I mean by that? Well, instead of using the golden cross for, say, QQQ, use the golden cross for SPY to buy or sell QQQ. So let's first look at the returns for the golden cross using SPY, QQQ, MDY, which is the mid-cap SPDR, and IJR. Well, you can see the returns were better, good returns, up over 7.5%, but we had higher drawdowns, 30, 25, 27. So the drawdowns are still a bit too high when we're using these ETFs with higher betas, basically. And that's to be expected because large tech stocks are more risky than the S&P 500 as a whole. Mid caps, small caps are riskier than the S&P 500 as a whole. So what would happen if we apply these SPY signals to QQQ, SPY, and IWM? Pretty impressive. You can see the returns are higher. We're now above 8%, 8.47% here. So that's good. The exposure, same as SPY, of course, because we're using the SPY signals. And lower drawdowns. All the drawdowns were lower. By the way, the risk-adjusted return is higher because you're exposed less to the market. So that 29% of the time you're not exposed is basically the downtrends. And so when your money's not exposed, it's not as at risk. And so that's why your risk-adjusted returns are higher. So when you're out of the market that 29% of the time, you might be able to find something else like treasury bonds or something that is inversely correlated to the stock market, or something that is going up. So let's compare these results side by side. So QQQ, when you use SPY for the signals, the compounded annual return improved 1.1%. MDY, it improved 1%, small caps 1%, and then you can see the maximum drawdowns were lower. So that's why I say SPY, the S&P 500, that is the index you need to use, and you can use it to time the other major index ETFs. So in addition to using the broad trend and the golden EMA cross for the S&P 500 ETF, I'm also using breadth indicators. All right, and these are kind of like the internals. All right, so I've got 3 breadth indicators to look at. AD%, which measures participation. High-low percent, which tells you the leadership bias. And the percent of stocks above the 200-day EMA. That tells you how many stocks are basically in long-term uptrends. So first we need the ideal breadth index. And that would be an index that includes large caps, mid caps, and small caps. And that would be the S&P 1500. All right, so if we use an index that includes all 1,500 of these stocks, we've really got a broad representation of the market. All right, you have around 924 stocks from the NYSE and around 568 from the NASDAQ. So that means if you're using breadth indicators based on the NYSE data or the NASDAQ data, you're not playing with a full deck. All right, if you're going to use breadth indicators for the NASDAQ, put a chart of the NASDAQ under it. If you're going to use breadth indicators for the New York Stock Exchange, put a chart of the New York Composite under it. But don't show a breadth indicator for the New York or NASDAQ data and put a chart of the S&P 500 on it, because it's not the same. This is a true broad index, the S&P 1500. All 9 sectors are represented as well. So the first thing we want to do is identify a dramatic shift in participation. And this can sometimes precede a golden EMA cross in the S&P 500. And we're going to do that with AD%. And that is basically advances minus declines divided by total issues. It's the percentage of net advances. Now, when you chart it on a daily basis, you can see that it's fairly noisy data. And there was a time when we used to use these minus 90% down days and plus 90% up days. But we got more and more of those, and it became less effective of an indicator. All right, here you can see we had on the S&P 500, we had 2 90% down days, and in between was a 90% up day. And you can see that November rally did start with a 90% up day up here. But I found it's better to smooth out your data a little bit. If you're already in an uptrend, you can use these 90% up days to look for that one-day breadth thrust. Now, these indicators I'm going to show you, we've been in a bull market basically since late March. So you'd be looking for bull signals when you're in a bull market, shorter term. So what is a bullish and bearish thrust? Well, we've seen these indicators. There's this wide breadth thrust. There was the breadth thrust continuation from Gerald Apel, creator of MACD. And I studied these indicators, and I came up with some tweaks and some rules. And they were using NYSE and NASDAQ data, but I'm going to apply these to the S&P 1500. All right, so what I did was I've got a 10-day EMA of 80% for the S&P 1500. And keep in mind, again, I'm looking for a dramatic shift in participation. And that happens when you move above plus 30% as we did here in March 3rd to be precise, of 2016, or when you move below minus 30%, as we did in January 2016. So going back here, we had a bull thrust back in October 2014, and that ended with this August signal, 2015. Now we got a little whipsawed in 2015. That was a rough year, all right? But we had a breath thrust here around 2000, and we had a counter signal down here around 1950. So that was a bad whipsaw, but they're going to happen, all right? But this signal that we got here in March remains, all right? We've had a couple of other moves above plus 30%, but those just kind of confirm the ongoing bull signal. And you can see we haven't been below about 22% since this bull run. That's how weak the selling pressure has been. Even during the Brexit plunge in June, we didn't get below 20%. Next, we're looking for the leadership bias. Okay, and we're doing that with new highs and new lows. We're using high-low percent. So it's real simple. It's new highs minus new lows, again, divided by total issues. And we've got a chart here. We've got the S&P 1500 high-low percent at the top. And then we can break it down into S&P 500, 400, 600, and we even have it for the NASDAQ 100. And these are all available at stockcharts.com. So let's break down what I think is a bullish and bearish signal. So on the face of it, when you have more new highs and new lows, that's net bullish, right? But what I found was if you just use the zero line for signals, you got a lot of whipsaws. So you can see here you're moving up and down, above and below zero quite a bit. What we need is critical mass, all right? We need enough new highs to say, hey, things are bullish here. There's enough upside momentum here in these, enough stocks because they're making new highs that we have a bull market. And I tested some different levels and I settled on plus 10% and minus 10%. That seemed to limit the whipsaws and capture a significant change in the market. So going back here, we had a change in August. And you can see that in October, November, we didn't get a bullish signal. And we did have an EMA crossover. And we went back down below minus 10% in January, February. And then on March 30th, we went above plus 10%. And so we've stayed above plus 10% a number of times. We had that little correction here in November when we were just a little bit negative. But this indicator will stay bullish until we have a move below minus 10%. So this is telling us that the path of least resistance is up. It's telling us not to even look for bearish signals. All right, so the next thing we need is to look for the number of stocks in an uptrend. So we're going to use the percentage of stocks above the 200-day EMA. And again, we're going to look at it for the same group, the S&P 1500. And this can be broken down into the S&P 500, 400, 600, and NASDAQ 100 if you want a little more granularity and if you want to look at the chart. All right, you want to see when there's a dip, when it's turning back up. All right, so what signal lines are we using? Well, again, I'm not using the 50 line here, okay? Because if you use 50, you're going to get a lot of whipsaws. And what I've found with a lot of indicators is it helps if you put your bullish threshold just a little bit above that positive level or the midpoint, and your bearish threshold a little bit below the midpoint. So I've settled on 60 as my bearish threshold, bullish threshold, this line here, and 40 as my bearish threshold. So you can see we moved below 40 here in August, and above, nope, we didn't have it in October, November, and then below again in January. So this bearish signal stayed from August until March, and now we're on a bullish signal. All right, we had a deep dip here in November, but we didn't get close to 40. That was more of an opportunity than a threat. So what I've done here is I've put these three indicators together to give us a weight of the evidence approach. And I'm sure anybody who's read JC's articles, he likes to look at the weight of the evidence. All right, and I like to do that too. I don't look at just one indicator. I want to look at a couple, and in this instance, I've got three. So when two of the three are on bull signals, I think we're in a bull market. And that stays a bull market until two of the three switch to bear signals. All right, so this is kind of a way to confirm what you're seeing with the golden EMA cross on SPY. As you can see here, in August, we had a bear signal in 80%, and then a bull signal in October, but you didn't get bull signals in high-low percent, because high-low percent didn't make it above 10%, and you didn't get one in the percentage above the 200-day EMA. So that was kind of like saying, hey, something's not completely right here. All right, maybe you just want to go in with 50% of your money instead of 100% in the market, because we're not 100% bullish yet. And this strategy could also be used to scale into a position. As the EMA crosses above the golden EMA cross turns bullish, that's one step. 80% turns bullish, that's another step here in March. High-low percent turns bullish, that's another step. And the percentage above the 200-day turns bullish, that's another step to scale in. So we're currently bullish. And that means we want to buy the pullbacks. And it's very important that you set your broad market stance, because that dictates your trading bias. You don't even want to look for short positions or bearish setups when the broad market is in an uptrend or in a bull market. You want to look for pullbacks within an uptrend. You want to do mean reversion trading. You want to look for bullish patterns. Again, here's that correction in November. We didn't get bullish bearish signals, and that was more of an opportunity than a threat. All right, so once we have our market bias set, we need to turn to the sectors, and we need to pick the strongest sectors, because we can use that to either buy those sector ETFs or look for stocks or ETFs related to that sector as far as long candidates or for buying. We want to focus on the strong sectors. We want to avoid the weak sectors. So the first thing we do is we rank the sectors by high-low percent. So the high-low percent indicator I showed you for the S&P 1500, we also calculate it for each sector. And you can view it on one chart. Now this is a lot to see. I'm not going to go over this entire chart. I've broken it down into two, but if you're a Stock Chart subscriber, you can put all 9 sector high-low percent indicators on one chart, and you can put the S&P 500 high-low percent at the top for reference. So where do we stand now? The top 5 sectors. And it's great because it kind of gives you a visual approach when you're looking at these charts, and also something that you can put a number on. You can see the number of new highs. All right? And if you look here, you can see materials. Look at that, December. Over 30% of the stocks hit new highs. Same with January. And we look at technology. Technology was perking up in June and July when you had over 10% and over 20% of the stocks hitting new highs. So technology has been going good for quite a while. And again, it's over 35% of the stocks hit new highs this past week. Industrials, another top sector. You had this surge in new highs in July, and so that told you, hey, we need to focus on this sector. We need to look for stocks in this sector, because if you get the market trend right, and if you get the sector trend right, it makes it a lot easier to pick stocks that are going to be winners. You got 2 things going for you, sector and market. And look at that November, December surge in new highs in industrials. And then you get a dip, but that dip is telling you that these stocks are pulling back. And when they're pulling back within an uptrend, that's when your opportunity presents itself. And now we're turning back up. Here's finance, a lot of new highs in November, December. Some are pulling back now because we have fewer. And then we have consumer discretionary, and it's kind of just, we had some new lows in October, and new highs just can't get much above 10%. So still a bit of mixture in that sector. Now we look at the bottom four sectors, consumer staples, totally different picture. A lot of new highs in June and early July, but then the new lows started creeping in September. So this sector fell out of favor then. And you can see utilities, their new highs fell below 10%. It didn't get above 10%. So there were other sectors with new highs above 10% would have told you, hey, we need to adjust from utilities. You've been in utilities from February until maybe August. And in August, you would have started making adjustments to other sectors. Energy started perking up in the summer and then really caught fire here in December. It's currently in a pullback, but this is one to watch because these new highs, well, they usually don't come as isolated events. That's why we have trends, because you get a new high, you pull back, and then you move to another new high. So we might be in a pullback phase for a lot of energy stocks right now. And then here's healthcare. And this one's totally mixed up. You got some new highs, some new lows. So it's kind of, you got to pick the industry groups within the healthcare sector. So I also ran a scan, and this kind of quantifies it a little bit better because I ran a scan of the 20-day EMA of high-low percent. And this was the output table that I got at Stock Charts. And I sorted it by this high-low percent. And we can see materials, technology, industrials, and finance. This is where we want to be looking for stocks to play on the long side. And then we got the S&P 500 high-low percent as our benchmark. And the ones that are below it are lagging a bit. And healthcare is clearly the biggest lagger when it comes to the 20-day EMA of high-low percent. So we can also rank these sectors by the percentage of stocks above the 200-day EMA. And again, we can get all of these on one chart. And I'm not going to go through the whole chart. What I've done is I've done a scan. All right, and I've got them ranked. And it's a very simple way to do it, but we can see something happening here that looks familiar. There's the S&P 500 as our benchmark. 74% of the stocks in the S&P 500 are above the 200-day EMA. That's uptrend. All right, and look at the leaders: materials, technology, industrials, finance. Same four leaders as in the previous scan. Now we've got energy creeping above the benchmark, and we got utilities. All right, then we look at the bottom. Healthcare is down at the bottom, 50%. So you're still rolling the dice, so to speak, when you're dealing with healthcare, because there's a lot of weakness still in the sector. Consumer discretionary ain't that great either, 61%. So there's some downtrends in consumer discretionary. That means 49%, 48.47% of the stocks in the consumer discretionary sector are below their 200-day EMA. So you don't want to fight that trend. You want to make the trend, to give us a cliche, you make the trend your friend. And that means you trade in the direction of that trend. So that's what this is telling you, is 96% of stocks in the materials sector are trending up. That is valuable information when you're looking for stocks. And you can take that information and you can go look for the scooters that Greg Schnell was talking about. Look for stocks in the materials sectors that have scooters turning up, or technology, or industrials, or finance. So the last breadth indicator I've got is the bullish percent index. All right, and that is an old indicator. It's based on point and figure charts. And basically, it's the number of stocks, their percentage of stocks that are on a double top breakout. And that's a P&F buy signal. So here you can see two columns, column of X's, and then the second column of X's moves above the prior one. That's a double top breakout. All right, and it stays valid until there's a double bottom breakdown. And the last one was that red C, but that was reversed here. So we want to know the percentage of stocks that are on a double top breakout, a higher high. Because if you're making higher highs, you're in an uptrend. All right, so we can rank the sectors by that indicator as well. And look at the top 4 sectors: technology, finance, industrials, materials. There seems to be a theme working here with these 4 sectors. All right, energy just got above the benchmark. So again, energy is an interesting sector because it's in the midst of a pullback. I know when you look at XLE, ExxonMobil's been weighing. But what I'm trying to do here with these breadth indicators is show you what's happening internally, inside the sector. When you look at the sector SPDRs like XLE or XLY, they may be going up and hitting 52-week highs, but they are also, well, XLE is not actually, it's pulling back. But XLY is a very good case in point. You've got leadership coming from Amazon and Comcast, and they're the ones that are pushing it higher. But the equal weight consumer discretionary sector is not doing so well because it doesn't have that heavy weighting for Amazon and Comcast. So these internal indicators like bullish percent and percent above 200-day EMA tell you what's happening inside the sector, what's happening to the individual stocks. And when you see that there are more stocks and uptrends and making new highs, that's the sector you want to be looking in for potential buying opportunities. So what have we learned here? It's a bull market, all right? We are in a bull market. And in a bull market, we want to use pullbacks as opportunities. As Brian Shannon was saying, you know, when you break below the 50-day EMA, that's not necessarily bearish. That might be a bullish opportunity because the 50-day EMA is above the 200-day EMA. If you go below the 50-day, you're in a pullback. If you're in a pullback, that means your risk-to-reward ratio is better for a potential long position. So you want to hone in on those charts, maybe look at a 60-minute, maybe look at a daily a lot closer to look for that little upside catalyst. But it's a bull market, so we want to be looking for long positions. Second, the leaders, clearly, 4 sectors standing out: materials, technology, finance, and industrials. All right, and I think of these 4, technology is the strongest. You know, I look at the First Trust Internet ETF hitting a new high, semiconductor ETF hitting a new high, the software ETF hitting a new high, lots of strength in technology. Now, it might be right for a pullback, but you want to keep these stocks on your radar to be ready for that pullback. The one to watch, as I said, is energy. Because if you look on the XLE chart, you're going to see a nice little falling wedge over the last couple of weeks. And if ExxonMobil, which is around 15% of the ETF, can turn it around and get a breakout, that's one to watch. So keep your eye on oil and energy. All mixed up, consumer discretionary. You know, you saw the retail SPDR this week. It hit a new low for 2017, and it's also back to the same level it was around November 8th, which is just when the post-election rally was starting. So retail is really hurting, and that's probably weighing on the consumer discretionary sector, a lot of retail stocks in that sector. And the laggards, healthcare, consumer staples, and utilities. And these are like defensive stocks, especially staples and utilities. And if you're in a bull market, you want to be more on the offensive side of the market. You don't want to be on the defensive side. Healthcare, there are pockets of strength like medical devices and healthcare providers, but biotechs are dragging their feet, big pharmaceuticals are dragging their feet, so it's still not a sector I'm really interested in as a whole. Maybe within the sector you want to look at medical devices. But keep this in mind. Try to focus on the strong, try to avoid the weak, and remember, it's a bull market. And with that, I'm going to turn it back over to JC.
I love it, Art. I love it. I love all of it. I think a lot of the things that you said were so complementary to some of the stuff that Greg Schnell was speaking about this morning. Particularly with the strength in the sectors. I mean, you nailed it. I mean, technology, industrials, financials, right? I mean, that's where the strength is. That's where the relative strength is. That's where the momentum is. And then the weakness, obviously, healthcare, utility, staples. Let me ask you this. You touched on how, within healthcare, biotech and pharma suck, and the medical devices are showing strength. And obviously, I couldn't agree more. The work that you're doing at the breadth level, for example, the percentage of stocks above the 200-day moving average, are you doing that for the subsectors too? In other words, percentage of medical devices above their 200-day and stuff like that?
No, we're not doing that for the subsectors. For medical devices, you'd have to go to a chart and look at IHI.
You wouldn't want to break down the individual components of the medical devices, or, for example, in technology, the percentage of semiconductor stocks that are above their 200-day, for example, within the technology space?
Well, I would really love to, but we're not doing that yet at Stock Charts. We're just doing it on the sector level, and we also do the gold miners. So if somebody likes gold miners, they can find out that information.
Terrific. And then, before I let you run, we have Jonathan Krinsky here, which I'm super stoked to listen to what he has to say. Any final words? Where can they contact you? Any advice? Remember, we have tens of thousands of people interested in technical analysis from all over the world. Art is here from Belgium. Thank you for taking the time out of your day. But anything you'd like to, leave us with?
Well, I'll leave you with this percentage above the EMAs that we were talking about. We've got a whole list of indicators like that at Stock Charts. And we do the 50-day, the 150-day, the 200-day, and there's even some that do the 200-day. So there's a whole bunch of breadth indicators that you can find. And if you want to reach me at Stock Charts, you can always do that. I post on the Don't Ignore This Chart on Mondays and Wednesdays. And Greg Schnell also posts on that. You can always send a message through that. And there you can see I do a weekly market review and outlook with a video. And I touched again on these bullish percent index rankings and high-low percent index rankings as well. So if you want to see a weekly video that goes along with that, you're more than welcome, and please come by Stock Charts. You can also see me on Twitter, at Arthur Hill is the handle.
And are you going to be in New York at the beginning of April?
I am going to be in New York. I'm looking forward to it. You too, JC?
I will. I will be there. This is for you guys wondering. This is for the annual Market Technicians Association Symposium, which Tyler Wood touched on last night. So Art tells me that in Belgium they don't have great sushi. New York certainly has amazing sushi. So Art, sushi on me when we're in New York for sure. Save me a lunch, all right?
I'll take you up on that, JC. That's very nice to hear. Looking forward to seeing you and all the colleagues at the MTA. It's a wonderful event.
It is an amazing event. I encourage everybody listening to go to mta.org and find out about it. Art, listen, man, I really do appreciate you coming in. This was awesome. I loved it so much, particularly the breath stuff. I mean, I'm a big breath guy for sure. So I always learn from you. And a lot of the stuff at Stock Charts Chart School, Art Hill is the one who put a lot of that together. So thank you for that.
You're welcome. Thanks for having me, JC.